Best stocks to invest in for 2025. Where should you invest in 2025? That is definitely a question many of us are asking ourselves right now. And in this video, I will show you 10 stocks to invest in for 2025, according to Barron's. For those who don't know, Barron's is one of the most respected financial magazines in the world. And every year they publish their forecasts on the stocks that are set to perform well in the following year. 2024 was an incredible year for the Magnificent Seven, which are, as you probably know, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. These big tech companies helped push S&P 500 up by 25%. But here's where it gets interesting. Barron's believes that the landscape could shift in 2025. Now, let's pay close attention to their previous analysis. While their 2024 stock picks did not outperform the S&P 500, their 2023 picks outperformed it by almost 10%. This time, for 2025, Barron's believes the focus will shift to companies with strong fundamentals, attractive valuations, and promising growth prospects. From an Asian e-commerce giant to a European semiconductor monopoly, as well as spanning conglomerates, global banking, luxury goods, biotechnology, and energy, the 2025 list aims to diversify beyond the usual core stocks. Let's go through this list and see what they have to say about each stock. You can subscribe to our free newsletter, where we share access to online seminars and additional content to complement what you see here. Subscribing is free and gives you access to valuable resources. You'll find the link in the video description below. Alphabet. Alphabet, Google's parent company, appears once again among Barron's top picks, and that's no coincidence. While 2024 was an outstanding year for big tech, Alphabet stands out as the cheapest of the Magnificent Seven in terms of valuation multiples. Despite regulatory pressures, increasing AI competition, and uncertainty about how Waymo's robotaxis will fare against rivals, Google maintains a diverse and robust business portfolio. From its core search engine and online advertising, which generate massive profits, to cloud computing, YouTube, and its other bets like Waymo, Alphabet benefits from a significant internal diversification. On top of that, it has a strong balance sheet with over $100 billion in net cash, allowing it to expand share buybacks or even introduce dividends in the future. Barron's believes market concerns are already priced in and that Alphabet could climb higher if it proves its resilience in AI and monetizes its ecosystem more effectively. Now, let's move from Silicon Valley to China. Alibaba, the e-commerce and cloud computing giant, is seen as one of the most undervalued investments in the sector, especially when compared to Amazon. In 2024, Alibaba's stock underperformed, largely due to concerns about the Chinese economy, weak consumer spending, geopolitical tensions, and potential US trade policies. However, Barron's believes that most of this negativity is already priced in. Alibaba trades at just 10 times estimated earnings, while Amazon trades at over 40 times. Additionally, it holds around $50 billion in cash, equivalent to a quarter of its market value. If China's economy stabilizes or relations with the US don't worsen, Alibaba could rally up by up to 50%. And that's without even considering the hidden value in its stakes, cloud infrastructure, and vast e-commerce ecosystem. Just a quick tip before you rush in: if you're interested in buying any of the stocks featured in this video and want to explore trusted brokers, we've linked Rankia's highest rated ones in the video description below. You'll also find a link to the best brokers for your country with very competitive fees. ASML Holding. Few companies are as critical to global technology as the Dutch giant ASML. It is the leading supplier of extreme ultraviolet lithography machines, essential for producing the most advanced chips in the world. To put it simply, without ASML, chip miniaturization and performance improvements would be impossible. In 2024, ASML cut its forecasts, negatively impacting its share price. However, its dominant market position remains unchanged. The demand for semiconductors is set to rise in key sectors such as AI, data centers, smartphones, electric vehicles, and quantum computing. ASML holds a monopoly on the most advanced segment of lithography, benefiting from the ongoing trend of increasing chip complexity. Despite the stock correction, its competitiveness remains intact. Barron's describes ASML as the essential toll booth that all chip manufacturers must pass through, making it a compelling long-term investment. Berkshire Hathaway. Who doesn't know Berkshire Hathaway? The empire built by Warren Buffett and the late Charlie Munger represents a stark contrast to the tech-driven investment frenzy. With holdings in Apple, insurance, railroads, energy, retail, and hundreds of other businesses, Berkshire is a conglomerate that generates stable income and holds over $300 billion in cash. In 2024, Buffett was particularly cautious, avoiding large-scale purchases and even selling part of his Apple stake too soon. However, this does not mean the company is not well positioned to capitalize on a potential market correction in 2025. Moreover, Berkshire's strength does not solely rely on Buffett. The company has been structured to endure, with executives who fully understand the philosophy of the Oracle of Omaha. In a less explosive market environment, Berkshire offers a combination of value, resilience, and the ability to deploy cash when opportunities arise. Barron considers it a defensive anchor, capable of delivering solid long-term returns. In the banking sector, Barron is betting on Citigroup, a bank many see as a laggard among US financial giants. While JP Morgan and Bank of America trade at higher multiples, Citigroup remains below its book value. However, a transformation is underway. Under the leadership of CEO Jane Fraser, Citi is shifting focus towards more profitable divisions and aiming to improve return on capital. Citi is a leader in international payments, has a top 5 investment banking division, and is highly competitive in credit cards. If it succeeds in boosting profitability, the market could reward Citi with a valuation more aligned with its size and global presence. Prominent banking analyst Mike Mayo believes Citi could be the biggest financial surprise of 2025. According to Barron's, investing in Citi today is like buying at a discount, anticipating that its restructuring plan will succeed. Now, let's shift focus. The world is facing increasing risks, more frequent natural disasters, extreme weather events, and geopolitical tensions. In this context, the reinsurance industry is becoming more important than ever. Everest Group is one of the largest global reinsurers, yet it trades at such low multiples that it appears to be a company in trouble, when in reality it's not. The market fears Everest may need to increase reserves for future claims, but even if that happens, the company maintains a strong financial position. The demand for high-quality reinsurance is growing, and Everest aims to generate annual returns of 17% through 2026. If concerns over reserves subside, the stock could take off. This is a contrarian investment opportunity, buying when the market fails to reflect the company's underlying strength in an industry with long-term tailwinds. Luxury is a cyclical industry, and 2024 was not a great year for LVMH due to weaker consumer spending in China, its most important market. However, global wealth has not disappeared, and the demand for iconic brands such as Louis Vuitton, Hennessy, Tiffany, and Bulgari remains strong. If the Chinese economy rebounds and the wealthy Asian class regains its appetite for Western luxury, LVMH could return to a strong growth. With undisputed leadership in fashion, jewelry, wines, and spirits, LVMH has extraordinary pricing power. Its valuation has adjusted after the slowdown in China, making Barron's see it as a buying opportunity before demand recovers. Now, luxury is not just about discounts. It thrives on scarcity and prestige, and LVMH is the ultimate embodiment of this philosophy. Moderna. During the pandemic, Moderna was the darling of the stock market, thanks to its COVID vaccine. However, after an initial explosion in demand, sales declined, and the market now perceives it as a company without a clear future. But is this fair? Moderna still holds around $9 billion in cash and is actively working on an extensive pipeline of cancer and respiratory vaccines, some in collaboration with Merck. Current market skepticism has pushed Moderna's valuation well below its potential. If even one of its oncology projects or its combined flu and COVID vaccine succeeds, the stock could soar. Investing in Moderna involves risk, but it also means paying very little for a progressive mRNA platform, which could lead to the next major pharmaceutical breakthrough. Barron's believes this undervaluation presents an opportunity for investors with a medium to long-term horizon. The energy transition is real, but oil and gas will remain crucial for decades. Within this context, SLB, the world's leading oilfield services provider, holds a privileged position. Operating in over 100 countries, SLB dominates critical niches in the energy supply chain and has a digital business that enhances efficiency for its clients. Despite trading at much lower valuation than its historical multiples, SLB continues to generate strong cash flows. Given that hydrocarbon consumption will not disappear overnight and that oil companies are looking to maximize profitability, SLB remains the ideal technical partner. Barron sees SLB as a sensible investment, combining expertise, innovation, and the resilience of a sector that will remain essential even in a greener economy. Finally, Uber. Many fear fear that the rise of autonomous vehicles, such as Waymo's robotaxis or Tesla's self-driving technology, could render Uber obsolete. However, Uber remains the world's largest mobility network with over 150 million active users. Managing logistics, demand, and payment systems is not something that can be replicated overnight. If robotaxi companies want to scale quickly, Uber is the most logical route to reach end consumers. Today, market uncertainty is weighing on Uber's stock price, but Barron believes that this fear is already priced in. In the long run, Uber could integrate autonomous vehicles into its platform, boosting efficiency and evolving into a mobility aggregator, seamlessly combining human drivers and self-driving fleets to maximize availability and reliability. What do you think of these stocks? Do you believe Barron's will be correct this time? Let us know in the comments below. And here's a direct link to one of the top brokers recommended by the Rankia community, where you can buy any of these stocks. And we will see you in the next video.